35.06 USD. That is the number flashing on the screen right this second. It's up 0.22 cents, roughly 0.63% in positive territory for the day. We are looking at Chewy, ticker symbol CHWY, and if you are watching the order book right now, you are seeing a fascinating battle play out between the $35 support level and the sellers trying to cap this momentum. The market is open, the volume is ticking up, and the tape is painting a picture that is significantly more complex than just people buying dog food. Most investors look at this chart and see a standard e-commerce retailer trying to find its footing after the pandemic boom. They see a company that sells kibble and squeaky toys. That is the expectation. It is the safe, comfortable narrative that keeps this stock hovering in this mid-30s range. But the reality? The reality is that you are looking at a company that is quietly undergoing a metamorphosis into a high-margin healthcare infrastructure play, and the market is only just beginning to wake up to the discrepancy. If you are sitting there with your Schwab Intelligent Portfolios or checking your balance on Fidelity Investments, you might be wondering why this stock isn't trading at the multiples of a tech company yet. That is the question we need to answer today. This isn't just about moving boxes from a warehouse to a doorstep. It is about the data, the recurring revenue engine, and the aggressive expansion into the medical side of the pet economy. Let's look at the intraday action first because it tells us a lot about the current sentiment. We opened this morning with a slight gap, testing the resolve of the bulls immediately. You can see the buying pressure coming in every time the price dips below that $34.80 mark. It's acting as a psychological floor. The volume today is healthy, not explosive, but steady, suggesting accumulation rather than a frantic retail pump. This is the kind of price action you want to see if you are building a long-term position. Methodical, stepped buying that absorbs the selling pressure without breaking the trend. When you look at Interactive Brokers trading data, you often see institutional block orders sitting just below the current bid, acting as a safety net. This tells us that the smart money is comfortable accumulating here. They aren't chasing the price, they are letting the liquidity come to them. Now, why is this happening? The common belief is that Chewy is locked in a death match with Amazon. The bear case is simple. Amazon has infinite logistics, infinite capital, and they can crush anyone on price. If you browse investing sites or read the headlines on your Robinhood app, that is the story you get fed. Chewy is great, but can they survive Bezos? That is the surface-level analysis. But here is the contrarian take that forces you to rethink the entire thesis. Chewy isn't competing with Amazon on logistics anymore. They're competing with your local veterinarian. Chewy has effectively built a moat around the most lucrative part of the pet owner's wallet: healthcare and prescriptions. When you buy a bag of dog food on Amazon, it's a transaction. When you set up an auto ship on Chewy for your dog's heartworm medication, it's a relationship. And that relationship is sticky. The auto ship numbers, which we will get to in a minute, are the heartbeat of this company. They provide a level of predictability that most individual brokerage accounts dream of finding in a stock. Let's pause on that $35.06 figure for a second. It represents a consolidation zone. We have seen Chewy touch the high 40s and dip into the high 20s over the last 52 weeks. Currently, it is coil springing. The technical indicators are showing a tightening of the Bollinger Bands, which usually precedes a significant move. Whether that move is up or down depends entirely on how the market digests the next phase of their strategy, the ad business and the international expansion. If you are using SoFi Invest or Fidelity Wealth Management to track your sector exposure, you know that the consumer discretionary sector has been volatile. Inflation hits the wallet and people cut back. But, and this is critical, pet spending is historically recession-resistant. You might skip buying a new TV or delay that vacation, but you are not going to stop buying food or medicine for your dog. That biological necessity transforms Chewy from a pure discretionary play into something closer to a consumer staple. That is a distinction that algorithms on Interactive Brokers stock trading platforms are starting to price in, but the broader retail market hasn't fully grasped it yet. This brings us to the core business model, which is often misunderstood. People think of Chewy as a website. You should think of it as a subscription service. Over 75% of their sales come from auto-ship. This is the Netflix for pet food model. Once a customer locks in that recurring order, the churn rate drops significantly. This creates a negative working capital cycle that is beautiful for cash flow. They get paid by the customer before they have to pay their suppliers. This efficiency is what allows them to invest in things like automated fulfillment centers, which drive down their cost per package. When you look at the recent earnings reports, the metric that jumps out isn't just the top-line revenue, it's the net sales per active customer, or NSPAC. This number has been climbing steadily, approaching and crossing the $500 mark and heading towards $600. This means that Chewy isn't just acquiring new customers, they're getting existing customers to spend more. This is the share of wallet game. Initially, you buy food, then you buy toys, then you buy flea medicine, then you buy pet insurance. Eventually, you're using their telehealth service. Chewy is systematically capturing every dollar you spend on your pet. Speaking of telehealth, this is where the reality really starts to separate from the expectation. The expectation is that Chewy sells physical goods. The reality is that they are building a service layer on top of their retail business. Connect with the Vet allows auto-ship customers to chat with licensed veterinarians for free. This seems like a nice perk, but it's a data mine. It keeps the user on the platform, builds trust, and inevitably leads to product recommendations that can be fulfilled instantly by Chewy's pharmacy. It closes the loop. If you are managing your own funds through self-investing on Fidelity trading platforms or using Schwab intelligent portfolios, you know that ecosystem lock-in is the holy grail of tech investing. Apple does it with the iPhone and the App Store. Chewy is doing it with your pet's health. Let's talk about the stock's recent behavior in relation to the broader market. The beta is relatively high, meaning it moves more than the market. This creates opportunities for traders using Interactive Brokers platform or Robinhood stock trading strategies to capture swing trades. However, for the long-term holder, this volatility can be noise. The institutional activity we have seen over the last quarter is telling. We have seen heavyweights re-entering the stock or increasing their positions. When you see 13F filings showing accumulation by major funds, it's a signal that their internal models, likely much more sophisticated than the free tools on most investing sites, are flashing a buy signal based on long-term cash flow projections. Comment below how many shares of Chewy you currently hold, or if you are waiting for a dip to enter. Do you think the push into veterinary clinics is a smart move or a distraction? This push into physical vet clinics is the next frontier, Chewy Vet Care. This is a bold move. It takes them from the digital world into the physical world, directly challenging the fragmented market of independent vet clinics and corporate consolidators. The risk here is execution. Running a website is different from running a brick-and-mortar clinic. Leases, staffing, overhead, these are new headaches. But the upside is massive. If they can use their data to drive traffic to their own clinics, they capture the service revenue that has previously leaked out of their ecosystem. It's the same logic behind Amazon buying One Medical. If you are looking at SoFi stocks or considering adding this to your Fidelity eras, you have to weigh the valuation. Chewy rarely trades cheap by traditional value investing standards. It usually commands a premium because of its growth rate and its market dominance. However, compared to its pandemic highs, the multiple has compressed significantly. We are no longer paying for growth at any cost. We are paying for profitable growth. The management team has pivoted hard towards EBITDA profitability. They are no longer burning cash just to acquire customers. They are focused on the quality of the cohort. Let's discuss the ad business. This is a sleeping giant. Retail media networks are incredibly high margin. Amazon proved this. Walmart proved this. Chewy has millions of high-intent shoppers searching for specific brands. Selling ad space to Purina or Blue Buffalo is pure profit. It monetizes the traffic they already have. Analyst estimates suggest this could add hundreds of millions of dollars of high-margin revenue to the bottom line over the next few years. This is the kind of catalyst that isn't fully baked into the current share price of $35.06. When the market starts to model this ad revenue correctly, we could see a repricing of the stock. The competition is relevant, of course. You cannot ignore Robinhood crypto traders who might view Chewy as old news compared to the latest meme coin, or the Fidelity ETFs that might be underweight on consumer discretionary right now. But the competitive landscape in pet retail is unique. It is emotional. People treat their pets like children, and that emotional attachment creates price elasticity. If the price of your dog's special kidney diet food goes up 10%, you don't stop buying it. You grumble, but you buy it. This gives Chewy pricing power that other retailers lack. Furthermore, let's look at the international expansion. Chewy recently made its move into Canada. This is their first step outside the U.S. The Canadian market is similar to the U.S. in terms of pet ownership culture, but it's less saturated. If they can replicate their logistics efficiency in the Great North, it opens up a new revenue stream. And if Canada works, the